Everyone, and welcome back to the new Blueprint strategy course. By now, you have an extensive understanding of the commercials and how they make money in the market. They are the accumulators and distributors. And you also have a better understanding of the retailers. They are just straight up gamblers and usually do the wrong thing at the wrong time. And today, we're going to cover the non-commercials. The non-commercials, they're also large traders, just like the commercials. However, the non-commercials, they are mostly commodity funds or fund managers. Contrary to the commercials, they are in this market for one single reason. They speculate. Their strategy on making money is therefore very different. And to make sense of this, you just need to look at the COT net report and check how the non-commercials activity interplays with the price chart of any given market. And I'll showcase that in just a second. Let us first talk a little bit more about the non-commercials. Who are they? The non-commercials, they consist of fund managers mainly, but you may ask, what are funds? Well, funds are massive pools of money, which is managed. And because it's managed by an asset manager, it will automatically follow existing trends. So these guys, the non-commercials, they are what we call trend followers. They usually buy strength and they sell weakness. That's contrary to the commercials who sell strength and buy weakness. So let's make an example here for the non-commercials. Let's say a market breaks out of a given range within a few days or a few weeks, and the market makes a new high. What funds will do is they will buy that new high. Maybe they'll buy it initially with 100 contracts, and then as the market goes into a new high, then they'll buy more, let's say maybe 25 contracts. And then the next weeks, the market goes even higher, which then means they will buy even more, maybe another 10 contracts. And in doing so, what they hope to do is they hope that they eventually catch a big move. So this understanding is important because that is partly how we're going to look at non-commercials. What this also means is that when we look at the COT report, the non-commercials have a large position at a market high, like you can see here on the euro. This is a market high, and the non-commercials have a large position at that market high. They also had a large position at that market high, and they had a large position at that market high, and they had a large position at that market high. And again, they seem to have a large position. Also, what you will notice is that they will have no or a low position at a market low, like for example, here. Or for example, here. Or for example, here, where they had a low position and a low position, and here where they had a low position. So that's a bit counterintuitive now, right? And I know exactly what you're thinking, because this looks really, really strange. Because how the hell do these guys make money then if they're always positioned if they're always positioned with a lot of contracts long when the market is near a high, and they're always positioned with a lot of contracts, well, short when the market is near a low. The answer is, it's because what we don't see is their average cost. Okay, and their average cost is not all at the highs or at the lows. Usually what they do is they start off with large orders and then they average in over time with the idea to catch a big wave. And oftentimes that's also what we're going to see within the charts, that the commercials will have a large order and their jumping position before even the market is going to take off. So they have a large order and their jumping position before the market even takes off. Okay, so they'll have large positions in the beginning and then they average cost in over time. That's just what they do. And their idea is to catch a big wave. So if that's the idea, then that also means that these guys are not in and out traders. Okay, like many people perceive fund managers to be day traders. No, they're not. They are professional money managers, kind of just like us. They believe in the trend is your friend and therefore will go with it until the end. And the longer a trend has been continuing for, the more longs or the more shorts they will have on over time. Why do they do that? Well, they do that because they understand that most likely going with the trend is a lot easier than going against the trend. The caveat here is for some markets. Okay, so the non-commercials, as their trend followers, will be the most accurate on the markets that show strong existing trends. What markets show strong existing trends? Mostly Forex markets, right? Because within the Forex markets, you have large trends that stretch over years and decades, unlike in any other market. So for example, for the euro, we can see that even on the weekly time frame, we have been downtrending for over a decade, right? We have been downtrending for over a decade. So it makes sense that those non-commercials are especially interesting for us when we look at those markets where we also see large and continuing trends, because on the other hand, it's also the non-commercials that will continue to sell or buy into these long-lasting trends. So non-commercials are trend followers. They are responsible for the continuation of existing trends. But just like any other player in this game, also the large commodity funds or the large fund managers, they will eventually run out of ammo. Okay. And when they shot all of their ammo, or in other words, when the net positions are at multi-year highs and multi-year lows, those long-lasting trends are usually about to end. Okay, so when they're at multi-year highs, that's when we can assume that they may have shot all their ammo. And if there's no one left that is going to be responsible for pushing a certain market into that trend direction, then eventually that trend has to change. Okay, so if they're at a high net position mark, then very likely that they've shot all their ammo and very likely that trend is likely to end. So what's the major takeaway here about the non-commercials? The major takeaway is that they are, again, trend followers. And therefore, we want to use their buying and selling activity and put it into context of what they're doing right now in regards to existing trends. So we would only look at non-commercials if we can argue a clear trend based on our rules, and or if we can argue the beginning of a new trend where we do not time the low of the low or the high of the high, but maybe the first higher low or the second higher low or the first lower high or the second lower high. And how we do that exactly, I'm going to show you now. But as always, it's just crucial for you to understand how the non-commercials, who the non-commercials are and how they make money, because that is going to determine how we look at the non-commercials when we do the analysis. So to drive all of this home, we're going to do a little bit of practice. And the non-commercials are really the most abstract group, even though in theory they should be the easiest because they follow price very accurately. And I'll try to make it easy for you to understand, but it's not going to be used within the index. For the fund managers, we're going to use the net positions only. And only at times we may use the index, but if we become really good at reading the nets, then we also don't need the index. Okay, so what I want to do is I first want to load in euro. So since we don't have euro yet here, I mean, we do have euro, but we only have euro USD. And so if you're going to load euro USD and you have the COT loaded, then you're going to get an error message on your events log, and it's going to read commitments of trader studies can be applied only to future symbols. So that's a problem, right? Euro USD, that's not a futures, that's a Forex pair. The COT can only be applied on a central marketplace on futures. So we need to look at futures. And again, that's the benefit of looking at futures, so that we can see what the commitment of the traders is, not just the non-commercials, but also the retailers and the commercials. The workaround for us is that we're going to look at the euro futures pair. So how are we going to do that? We're first going to add a label row, and we're going to name that currency futures. And now we're just going to add @EC. Okay. And now we get Euro FX continuous contract, and the Euro FX continuous contract is just like the euro. It will look exactly the same, though there may be a slight price difference on the right. However, most of the time they track one another very accurately. Why are we looking at the currency futures? Well, again, we're looking at the central marketplace. And since we're looking at @EC, what I now can do is I can go to my studies, add study, and I can now get the fund managers, the Campus COT fund managers loaded into our charts right here. So now I'm looking at the euro on the weekly chart, and I'm looking at the fund managers down here for the euro. Now, if, for example, you're unsure about a certain symbol, right, and you want to look that symbol up, so you go to right mouse click, data, add symbol, and then you go to look up. You want to look at futures. For example, let's say you want to look at the Mexican peso. Right, let's just make an example here. And we'll try to look that up. Now we get a whole lot of MPs. And so what we want to look at again is the continuous contract. So we have a continuous contract here. And that's the only continuous contract. We have another continuous contract here that may be the mini, I'm not sure. But what we would want to use is the add MP1 here. Press OK, add MP1. And now I would get the Mexican peso. And for the Mexican peso, to also get the non-commercials. Right, again, once more, data, add symbol, lookup, futures, British pound, look up. I can see now a lot of different things here. And here's at BP, which is the continuous contract. And that here would be the contract month and year specific continuous contract. I think that's what it was for MP as well. So you have the M and the 23, which is for the expiry, June and 23, the year 23. But we want to have just the one that's not month and year specific, which is at BP. Okay, and now it's loading British pound. And again, with that, I'm getting the fund managers as well. If I were to go to GBP USD, you can see again, oh, it's gone. I get the error message. Commitment of trader study can only be applied to future symbols. Right, I go back to my at EC and I go back to my studies, add study. And I add the fund managers. And I could even add the retailers. And I could even add it's always hidden in the back somewhere here, the users and producers, the commercials, right? So I could add all of them for today. And for the euro, what we want to do is we only want to look at the non-commercials. So now, how do we use the non-commercials? Well, it's actually quite simple. Let me just write something here if TradeStation will allow me. Yes. So first thing is we're going to look at multi-year extremes. Second thing is that we're going to look at divergences where the COT net diverges with price pivots, okay? And then we're going to look at consolidation, breakout, and then we're going to look to defend that those consolidation and breakout areas, which then will be visible to us in form of supply and demand areas. Okay, so we're going to look at multi-year extremes, and we're going to look at divergences, COT net versus the price charts and pivots. And then we're going to look at consolidation breakouts. The breakouts, they don't necessarily have to be consolidation. They can also be trend breakouts. And then we're going to look to defend those breakout areas by trading the supply and demand areas. Okay. And that is what most accurately works as we look at the non-commercials. And so if we just gonna work from left to right, for example, and we could start here, but we could also start a little bit further to the left, so we can do a little bit of an exercise. First of all, Let us remove the trend here. And then let us look at potentially starting with this extreme here, right? So let's just see how the commercials usually act in the marketplace. So we know that this is an extreme, right? We know this. How could we have known that this is an extreme? Well, in looking to the left and understanding that this was an extreme, right? And we know that if this is our baseline, and we know that this eventually created a big drop in price, then we know that starting from here, we're starting to be extremely high up in terms of a multi-year high, right? So that is now a multi-year high. We know that, and it's been a multi-year high since here. However, notice the trend did not change until here. So what really happened at this stage that the trend changed, or that we moved into this downward spiral, that price really shot down? Well, if we know that we're at a multi-year extreme, then we're going to look at divergences. So what is a divergence? Well, a divergence would be if I, for example, here have the same high, and here I already have a lower high. Okay, so here I have a divergence. It's not as clear. However, that could be a divergence. What do I also have? I have consolidation breakouts, trend breakouts. So I have a consolidation and I have a breakout, and I also have a trend and then a breakout. And I also have, for example, where did we break a pivot before? There's a pivot, there's a pivot, there's a pivot, right? All of these would be prior pivots. This year, for example, may be quite interesting, or this year may be quite interesting here. So here also we broke a pivot. So let's stay with that trend breakout. So the trend breakout here is where my vertical line is here, right? And now all of a sudden, what I have here is I have also supply that was being formed. And notice how we're breaking out here. We have not yet broken this low, right? We had not yet broken this low. And then eventually, as price comes back into this supply here on the wider version, right? If we put the preferred, then we would have never gotten into this, but we talk about timing at another time. Today, I just want to speak about the setup and then how that translates to potentially finding the right trades for us. Because here at this stage, we could have had two options. We could have said, well, the trend is up. And of course, the trend is up. So what do I want to do? I want to buy with demand. However, if you're following the non-commercials, then you know, wait a second, the non-commercials have been at a multi-year high, and they have consolidated, and they've broken out of trends and channels and whatever you may have here. That means that we don't want to buy this. It means that we want to sell, because the trend is more likely to end here. And what in fact happens is also that the trend is changing. Okay, and so going further, so if we are missing this sell point, and then we're looking at, okay, when does price break a pivot point that was important before? Here, when does the COT break that pivot point, right? It's here. Then we also know something happened here where I need to find supply. And granted, there's no supply, right? There's no high quality supply. However, we can see that these areas here are being defended by whoever created that breakout. So the non-commercials, the fund managers that put in very large positions here, and once they make a move, they will defend their areas. Of course, they'll defend their areas, because if price was to go higher, they would what? They would lose money. So they don't want to lose money. Sometimes they will lose money, but they don't want to lose money. So they will add more and more and more. And as the trend persists, they will add more and more and more. And then eventually, again, here we have a consolidation. And within strong trends, it may also be smaller areas of consolidation. Here, for sure, we have a few weeks of them consolidating, and then they're breaking that prior low. This goes into a new low. And what happens at those areas is now, for the first time, maybe we have actually created some nice supply in the process. And so what we want to do is, we for sure want to short that supply. Why do we want to short that supply? Well, because the trend is shifting. So drop-based drop, price comes back, and we want to short that supply. So we came from multi-year highs. We didn't quite see a divergence, maybe a little bit. Then we saw consolidation breakout. We marked those consolidation breakout areas with a horizontal, then a vertical line. We see if there's some quality supply that's being formed that we can then use to time the markets. And we know that those supply areas have been created by large traders because it's the fund managers. And so we have a little bit more likelihood behind our supply and demand zones that there's actually some buying or selling power behind our zones. Unlike if we were to trade the demand here, well, that's not a good idea. Why is it not a good idea? Even though it worked a little bit here on the second one, it's not a good idea because the fund managers they have shifted their trend, right? So they have shifted and they're gonna go down and force that trend until they again are at a multi-year extreme. So when we see those multi-year extreme and then breakout areas, we know the direction of the trade that we want to take. At this stage, I do not yet have a trend in place, right? I just have maybe a first impulse move, but then I get the first correction and I'm trading the first correction with the first quality supply that we found. And so I'm trading the first lower high within what may be a new downtrend. Then where else do we have another low broken? Here's the next low. Then that low is broken here. And again, what's going to happen is as that low is broken, we're going to form supply in the process. Drop, base, drop. Drop, base, drop. And what happens is, again, as price comes back into this area, and we can do this on the wider, the fund managers will defend their areas. Okay, they will defend their areas. Then again, where's the next low that's being broken? Here is the next low that's being broken here. And then, okay, where do we have supply? Well, we may have again a drop-based drop. We couldn't put in that drop-based drop. Price came in again, very deep inside this. And then again, we can see it's being respected by price, right? It's being respected by price. So over and over again, as we follow these trending markets, we want to go with the non-commercials, okay? Until eventually, of course. And by the way, we're going to do that for those markets until we see that one of those major highs here, right? For example, this is maybe a pivot. Maybe this would have been a pivot. We're going to do that until one of those is broken. And only if one of those is broken, we can look to predict the end of the band. Okay, that is very important. Only if one of those prior highs is broken, we can predict the end of the band, right? And that also only within multi-year extremes. So down here, eventually, they are quite low, yes, but we have never broken one of those pivot points, right? We've never broken one of those areas that these non-commercials may want to defend. And so here we see just the trend continues down, and these trends, especially within the Forex markets, they are vicious. They go on and on and on and on until no one expects it, and then it's going to change. So here, for example, as we know, this is for sure a multi-year low, and I base that on the 3-year low here, 2011, or even this year, or even here, right? 2016 or 2017 or 2016. So it's a multi-year low. And here a few interesting things happen, right? First of all, we see consolidation and we see a breakout, okay? And as we see that breakout, we're like, hey, we should buy, right? Hey, we should buy. What is price doing? Price is dropping, right? Price is dropping. Here, this was Corona. Nonetheless, we see price dropping, and the non-commercials, yet they're going into new extremes. So we may argue here, well, trying to buy that end of the band here, we may have been hurt here on this one, right? We may have been stopped out. After all, nothing works 100% as we then try to time the market. So for me, this here would be a timing issue, not a forecasting issue, because eventually what happened, as the fund managers are really putting a lot of contracts on the table, only later price follows, right? And then they're adding and they're adding and they're adding and they're adding. So what we then know is eventually, well, that trend here is going to end. And even though that trend hasn't ended yet, technically speaking, we can assume that it is going to end, okay? Because the non-commercials have switched sides and they've broken out, and they will defend their breakout areas, okay? They will defend them. So what's also interesting, what you can see here is, and that would be what I call a divergence, a proper divergence. So if I'm going to look at this here, and if I'm going to look at this here, then what I see is that price is actually lower, right? And or from high to high, that price is actually lower, but the non-commercials are higher. So I can see a very clear divergence of the COT net versus the price pivots coming from an area that is a multi-year extreme. We're getting the consolidation breakout, we're getting the trend breakouts, we're getting all of that good stuff. And what we want to do then at this stage is we want to buy demand. Now on the weekly, you may say, well, what demand am I going to buy? Well, yes, sometimes there will not be any demand. There will not be any pullbacks that we can buy, right? Then we would have said, oh, now there's nice demand. Let's wait for a pullback. Price never pulls back. Then there's nice demand. Let's wait for a pullback. Then price never pulls back. And price never pulls back because you can see the non-commercials usually go like this, but here they just go straight up. So as they just go straight up, price also just goes straight up. And there's very little chance of entering this. And this also sometimes is going to happen. However, here again, this is an issue of market timing again. It's not an issue of forecasting the market, right? So we're limited with supply and demand in forecasting. However, I'll show you other ways on how to get in and out of markets using price action or using our new software, which is the Campo Strategy Optimizer, which also gives you entries and stops. And we may use that to then enter the market. Then as price comes back into this quality demand, you may say, well, let's buy this again, right? Let's buy this. Well, you're missing the point, right? You're missing the point because at that time, again, things may have changed. So we need to track the non-commercials again. And here again, they are at a multi-year high. They're higher than they're here. And we may look to short this, right? Because of that reason, we may look to short this, predicting even the divergence and predicting the consolidation breakouts here, which has not yet happened. However, that's more difficult. Nonetheless, we may have gotten a little bit of a decline here, but price moved higher. So that's again an interesting scenario where what is happening? We're at a multi-year extreme and we're getting a divergence between the COT net and the price chart. Price chart is making a new high, but guess what the non-commercials are doing? They're starting to put a lot of contracts towards the short side. So at this stage, as this is a divergence, we could argue, well, now it's time to sell this, right? Now it's time to sell this. So then at that stage, you're going to say, well, let's wait for consolidation breakout. Consolidation. This is the prior pivot breakout. At this stage, we get a breakout. What do we have created in the process? We created supply in the process. As this is breaking out, we're creating supply in the process. How do we know that this supply is going to have sellers, willing sellers there? Well, we don't know, but we can argue that because we can argue that the fund managers want to defend their positions. So price comes up into supply and it takes a couple of weeks. And then eventually, as it goes deep into the zone, it then turns, right? It then turns. So that's, again, the first sign of a trend change. So here we are again trading the first lower high, and then price continues to decline. Where's the next pivot point? Here it's been broken. Here it's been broken. And what do we have? Do we have some supply? And very low quality supply, right? Very, very low quality supply. Man, if probably not even supply that I would be trading if I was sitting in front of the computer, right? Because quality matters. But with the context of the fund managers, clearly we could argue, well, this is now a downtrend. They will defend their positions. And notice how we're breaking out here. Right here, we're breaking out, breaking out, breaking out. Here, we have not yet properly broken out. So again, by looking at the non-commercials, we may get a glimpse of what the future may have in store for us if we apply it properly, okay? Because we get the breakout earlier here, and only after a while, we get a breakout here of this neckline here as well. And once we get a breakout of this neckline, it becomes, a self-fulfilling prophecy. All the supply is then just going to hold, drop-based drop, and we could find new areas. Here, for example, this is a low that was broken. Here, this low was broken here. And then what do we have? We have supply that's being formed in the process. price comes back, they will defend their areas and price shoots lower. So now, eventually, price is going to be, we're going to follow price again, right? We're going to follow price again until A, we're at multi-year lows, and B, one of those extremes is being broken, right? One of those extreme pivot points is being broken. And we can't really use these as extreme pivot points, right? Otherwise, we would have to use this and this and this. And that really doesn't make a whole lot of sense, right? We can use it on the way down, but we can't use it to argue a trend change. To argue a trend change, we really have to use these bigger pivots. So where does this change? Well, again, I could use it. I could put in a trend line. I could put in a vertical. And then let's use the trend line first. Here, the trend line seems to be broken. And then we for sure are broken here. And then price rallies. And we have a drop base rally. And then we're like, this is really a, a downtrend, a large downtrend. And it may not be so smart to be buying here. However, the fund managers are again showing us where potentially price is going to go. Then we put in demand, and then we get that one little dip in, and then we may be riding that. And as price is going higher, there's again very little chance to get into this. And now we're just moving about, but none of those, we're consolidating, but none of those pivots has been broken yet, right? None of those have been broken yet. That could argue a proper trend change. And so therefore, what's left to do is we're gonna have to continue to buy pullbacks into demand, and that uptrend is going to persist until we go into most likely high quality, higher time frame supply and demand. So if we are looking at the fund managers for those markets that are trending, then what we'll be able to do, and those, as you can see, those will be rare setups as well. We're looking at weekly charts. We're not trying to find trades every day. But what we can argue eventually is we can argue we may be able to find the areas where trend is shifting. And therefore, we may be able to short supply, short supply, short supply, short supply, short supply, and short supply until we get a break. And when we get a break, then we may be able to buy demand, buy demand, buy demand until we again are breaking those consolidation areas. And then again, it's shorting supply, shorting supply, shorting supply, shorting supply, whether we get a handle on this or not, right? So, but what is leading here is the commercials. Okay, that's what's leading. What is leading here is the commercials. Okay, over and over again. What is leading here is the commercials. And we could make examples over examples. And as long as these highs are holding, trend is being continued. And whenever those pivots break, trend is also going to break. Okay. Now we have a question that is very important. And Bash is asking, does this fund manager strategy work for all futures contracts, commodities, as well as just currency futures? Right. Just like with any strategy that I'm introducing, it doesn't work the same way. Unfortunately, I wish it was that easy on all of our markets that we love to trade so much. So it works the best on the markets that show very persistent long-term trends, right? So why does it work so well on euro is because the euro has been downtrending for a decade, right? Euro has been downtrending for a decade. So of course, what do we also know with this downtrend, if we do the technical analysis first, of course, before we go into the fundamental analysis, which is something that we have to do, is we can identify, as well as identifying on the non-commercials, the extremes, we can identify, well, what would I rather do? Would I rather look to sell with those extremes, or would I rather look to buy with those? Well, we know that correction, 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 and we know that the impulse moves are impulse, 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 right? So if we want to choose, and that's why those also work a lot better, and then those correction moves, for example, they come quick and then there's almost no time to enter. Those impulse moves, they'll work a lot better because that's just what the non-commercials do. They will follow this trend until the end, right? Until there's no euro that exists anymore. Of course, I'm kidding. But the commercials, you can argue, they are responsible for this, right? They're the ones that are responsible for continuing that trend. Now looping back to Bash's question, that's also what I created towards the end of the last session, as we talked about our finite markets, and then we talked about, well, we ideally need to create a list of symbols where we have a primary fundamental setup tool, a secondary fundamental setup tool, and on wheat, using the non-commercials really doesn't make a lot of sense, right? We want to use the commercials on wheat because that's a finite market. And then on natural gas, we said, well, we can use the retailers, but and we definitely shouldn't use the commercials for natural gas. But then for palladium, yes, it made a lot of sense again, right? So then again, every market is different. So what I created is a blueprint cheat sheet. That blueprint cheat sheet you can find within your classrooms. Blueprint including campus indicators, and on your fundamentals for market setups. If you go to get notes, then you get a blueprint cheat sheet, and I will continue to update that. And then I'll make sure that every month or so I'll have the updated version here. But what you can do as well is you can download it, and then you can continue populating that with the exercises that we do. So for example, here we can put in the euro, and what we have is we have the full list of our tools that are available in our toolbox. So we have the COT, the commitment of traders, split into commercials, non-commercials, retailers. We have the valuation, which comes in next time, where we speak about cross-market conditions, where we look at interest rates, gold, the ultimate storehouse of value, and the US dollar as storehouses of value, and how they affect the beautiful markets that we trade. Then we look at seasonality and how seasonality may affect the beautiful markets that we trade. We look at the optimizer, and of course, supply and demand. We're going to spend a lot of time on this as well. I know I've only scratched the surface on supply and demand, but I'm hoping to spend a lot more time on supply and demand, as it's the foundation of everything that we do, right? It's everything that we do is build on the supply and demand foundation, which is applicable and universal to all markets. It's universal to all income goals. And we need a way of timing the market with a good risk to reward proposition. Otherwise, all the tools that we have are are basically useless. So supply and demand, we need to spend a lot of time on. And you can see here, the legend is we have a primary tool, we have a secondary tool, and we have so-called odds enhancers. And so the primary with a 1, we can see on wheat, the commercials is a 1. It's a primary tool that we will use. Silver commercials, palladium commercials, natural gas, only retailers, and we don't use those. We may use the non-commercials. We have to look at that. Netflix, we haven't looked at yet, but now we talked about euro. And for the euro now, we can say we looked at the non-commercials, and for sure, the non-commercials seem like they're a good fit for the euro. And here we're going to have additional notes. You could put here whatever, maybe noting down what I had written here. Multi-year extremes, divergences, consolidation breakout, trend breakouts, right? This is anyways, these will be your non-commercial rules. So you anyways want to note them down separately or take a screenshot while this is up there as well. And so why does it work on Forex? Well, Forex is an infinite market. It's a man-made, it could also be a man-made commodity. And so the non-commercials, as their trend followers, they are a much better match for this specific market. And so that's what we could put here. And of course, supply and demand here as well. And then eventually you'll have a list of markets that we look at, and you know, oh, what is my primary tool? What do I need to focus on? What don't I need to look at? What do I need to do? And what are some additional nodes that are specific to the markets that we trade? So for example, on silver, if the commercials go net long, it's the ultimate buy signal, right? And so on natural gas, we said historical retailer extremes, 5-year or historical usually is a good time to sell. And so for each of the markets that we trade, as we look at them in detail, we'll find some unique ways of analyzing them. And in fact, this non-commercial strategy is a strategy that I only share with, that I had been only sharing with my mentees. So now I'm sharing it with everyone. This is kind of my Forex bread and butter, if you will. And I trade very rarely. I trade Forex markets. When I do, it's mostly with those extreme setups, divergence, consolidation, breakout, supply demand as a defending area. That's where I get in. And then I try to hold for longer, because those areas that we find that are built in Forex, they last for ages. And they break through the opposing levels like knives through butter. It's like, hey, what even is happening, right? It's like, hey, there's demand, right? Why does this demand not give me any reaction? Well, because we're not trading supply and demand with the right context of what the fund managers are doing. So Forex, mostly, not all Forex markets, but the ones, the majors, most majors, we want to trade with the right context of the fund managers, right? Forex is a speculation game. Who is in this market as speculator, and what big money in this market are speculators that we can see what they're doing? Well, the fund managers, they're large traders, they're big money, right? And they're speculators. So we can see what they're doing. They're following price, or they're creating that as well, right? And it's kind of a self-fulfilling prophecy. It's probably like chicken or egg conversation. What is doing what, right? Is the increase of price causing the fund managers to go all in, or is it the fund managers going all in that is then creating price to rally? In my opinion, it's oftentimes that the fund managers, right? The fund managers are the ones, because here man, they have really racked up the contracts and price hasn't even moved. It's made a new low. So eventually, as the fund managers are leading the way, we can get a glimpse of the future. Cervantes on my Japanese yen trade, yes, it was also the net non-commercials. It's a mouthful. The net non-commercials that I'm using, as well as the retailers. And we can maybe we have time to go into this in detail. But as you do these kinds of exercises as well on your own, you really will find that you know, it becomes a lot. Because in Forex, it's always, I found it's always, you try to get in, and by the time you get in, it's always too late, right? Because in Forex, what's important is to hit those major changing points, because also if we don't find them soon enough, then oftentimes also we're positioned at the wrong side of the trade, right? It's kind of like jumping in front of the train, which if the train gets moving in Forex, it's like ciao, right? It's ciao, ciao, ciao. So on this, we did talk a little bit about the euro. I think that makes a lot of sense. What we can also do is we could talk about the British pound. We could talk about Japanese yen. We could talk about Mexican peso. Wouldn't fall under this category here. But we could also talk about the US dollar. And I'll show you what your first sense check, Cervantes, and for everyone else in this room, what's your first sense check in understanding if what you're doing has merit or not. So what you're doing is you're just gonna check those extremes, right? You're just gonna check those extremes. And what you want those extremes to be, you don't want them to be super accurately predicting and timing the high of the high and the low of the low, because again, this is not a timing tool, this is a setup tool, and it may take weeks to set up. But when we find the right setup, these kinds of trades literally can make your quarter, can make your half-year performance if you find the right trade setup using this style of analysis. Like on the Japanese yen, for example, where if you're trading the Cervantes, are you in this trade, if I may ask? If you're in this JPY trade, then you're racking up crazy risk to reward ratios and longer term trades. So here you would see, as I look at this on the JPY, no, that's unfortunate. If you're looking at this on these points now, what you want to see is that eventually you see these shifts, right? And again, they don't have to be the same week. They have to be near, right? They don't have to be the same week. They have to be near. Sometimes they are pretty damn accurate, but most of the time they're only near, right? And that's why we also oftentimes look at then the divergences and the breakouts, because even though they are high, they can go even higher, right? Because here, for example, you're like, hey, they're high, I should sell. No, right? If they're high, it doesn't mean they can't go higher, right? These are fund managers. Eventually they are shooting all their ammo, but it's very tough to predict what that extreme is. Contrary to the commercials, it's oftentimes on finite markets a lot easier to predict their behavior because they do the same things over and over. And here as well, the lows, rally, low, eventually we get a rally, low, eventually we get a rally, right? We may be starting to be low, but not quite, right? Low would maybe be here or here, but we'll see. So here, by just doing that, you're like, hey, yeah, this has kind of merit, right? It makes sense. Also, by the way, the dollar is a crazy trending market. So, hey, that is trending. So who should I be looking at? Well, at the speculators. So we look at the non-commercials. let's look at that last. Well, let's start here and then we're going to work our way up. We have some time and I really want to also spend some time here. We could even start here or we could even start here. Doesn't really matter because it's mostly the same things that are happening. So here, eventually we're at a low, right? So this is an extreme. So what we need to see is, again, we need to see consolidation and breakouts of prior pivots. And here it may be a little bit more difficult, but here for sure we may have argued, well, this is consolidation, then we're breaking out here, and at that point we're like, hey, yeah, they're breaking out, let's buy demand, and then we buy demand, and then we get, right, and then we get stopped out. Of course, that is going to happen too, right? There's no 100% accuracy in anything that we do. So we're going to have to live with, especially if we do the end of the band, we have to live with the one or the other stop out. If we then, once we're following a trend, it's a different story. There's going to be less breakouts, but trying to find these ends of the band, that's going to be tricky, really, really tricky. And so here we may have said, well, here we are breaking the high, and then at this stage we are breaking the high, and then we're like, well, there's demand created before, but that demand that was created here was not the demand that created this high, right? And so also a bit tricky here. Nonetheless, we probably would have traded that and would have been stopped out. And then eventually, again, we're consolidating and we're consolidating, and then we're getting a breakout. And now as this is breaking out, price has already rallied quite a bit here, right? Price has already rallied quite a bit. So now this is a bit problematic here, right? Because price has already rallied a bit and we may have missed buying all of that unless we were anticipating that, which we could do. But now following our rules, it's very tough to get into this first rally. But what's very interesting to see is that if I'm looking at low versus low, and I'm looking at low versus low, or even here to here, then what is that? That's a divergence. So whatever price is doing is not reflecting, well, whatever the non-commercials are doing are not reflecting what price is doing and vice versa, right? Price makes a new low, but the non-commercials are not having it, right? They continue to accumulate. Hence the accumulation. Well, accumulation is actually the wrong wording here. That's for commercials, but they are consolidating, they are racking up contracts, and then eventually, as we get the divergence, we get the breakout. Once we get the breakout, now we can look at demand, right? And we wouldn't be shorting this anymore, right? No way in hell we would short that. Yes, it's downtrending, but hey, we're coming from a multi-year low and divergences and breakouts. This is a proper supply area where it's like textbook, and you would say, well, why the heck is this not working? And then you would go back and you would say, well, the non-commercials are just breaking out, coming from a multi-year low, and hence you're kind of jumping in front of the train here. So rather what we want to do is we want to find new demand at this stage. And we want to find new demand at this stage. And then we only would have been in this trade if we trade something on the wider version. If we trade something on the preferred, we never would have been triggered. But again, that's a timing issue. That's not a forecasting issue. And then as this goes on and on and on, it goes on and on and on, right? And then eventually we're high again. And that is similar to what we saw in the euro. We're high here. And then what is happening is we get a new high. But the non-commercials are not following that new high. So what's kind of interesting here is that this was during Corona, and of course, Corona is an outlier and we shouldn't really look at, you know, how could we have traded Corona, even though I find it quite intriguing to see, okay, what could we have done, or could we have done anything here? What we could have done for sure is eventually we would look to short, right? And at this stage, we don't have a divergence because we only see a divergence here. But at this stage, we have broken this pivot, and then we would say, well, eventually this should move lower. And our forecast was kind of accurate. However, not before it probably stopped us out once. It then turned lower. So the first time around, it's like, even if we find quality supply here within this area, it's like, okay, maybe we can short this, we short this, and then it's like, oh, right. So the next time we can short this is maybe here, as we create a new low here on the non-commercials. And then at this time we're here, though there's no supply that's being created, right? Unless we find supply to the left. But if we, for example, then look at this low, here we have supply that is being created. Nice supply, and then wait for the pullback, price never pulls back and it just goes lower. That's a shame, right? That's a shame. But again, nothing we can do about that. Here it would have been just like with the euro, it would have been extremely tricky to get into this trade, for sure. And then eventually, of course, I'm also operating on the weekly time frame, right? It may look different on the daily. And that's the beauty here as well, right? I'm doing a weekly analysis. However, that weekly analysis, the context of your weekly analysis can be applied to the daily as well, right? Because then you're going to look at the daily, you're going to find maybe a lower time frame trade that then even gives you more risk to reward, that gives you less accuracy, but more risk to reward if it works out. At this stage, you can argue, well, if here, you could argue, well, at this stage, I'm breaking out, right? At this stage, the US dollar is breaking out. And then at this stage as well, we're breaking one of those important pivot points. And so at this stage, what we have to do is we have to buy demand, right? We have to buy demand, and whatever demand you buy, if you buy the low here, or if you try it maybe once before and you're like, damn, that didn't work, so you're going to try again here. Now that worked, and then eventually you're understanding that the trend is going to shift here. Trend is going to shift, multi-year low, change of trend, consolidation, breakout. Here we're breaking out of this high. And then what's interesting here as well is at the same time, look at this right here versus this right here. So, whoa, the non-commercials again seem like they're front running everyone else, right? They're front running everyone else. And so what for sure we shouldn't do is shorting. We should be buying. And then again, consolidation, breakout. What are the breakouts here? And then maybe we find some demand, some low quality demand. Maybe we get in, maybe we don't. It doesn't matter. What matters is those breakout areas, then as the non-commercials are rallying, look how much they have put on the table in terms of contracts, and price hasn't even moved yet, but then price follows as well. And then price will persist that uptrend for a very, very long time until, again, we're at that extreme. And once you're at that extreme, you may argue, well, now again, I kind of have this trend here, right? Where is it broken? Right around here. So now I want to look to short. And what happens is that, again, one time too early, once too early, right? Price goes higher. But what's the interesting thing here again with that, with price going higher again, is from here to here and from here to here, it's a divergence, right? The non-commercials are not having it. And eventually, as again, we maybe stopped out once, but trying to predict that end of the band, man, that's tricky after that strong uptrend, especially since this is an uptrending market overall, right? So again, what is easier as per the COT so far, what has been easier is, well, this was very straightforward. This was very straightforward. What's kind of tricky is this was tricky and this was tricky because first it created a divergence before it then moved. And then as it moved, it's like, hey, how do I get in, right? And why is that? Well, because the US dollar is an uptrending, has been uptrending for decades. And so the non-commercials will have a lot, it's going to be a lot easier if we predict the lows rather than predicting the highs, because as we predict the highs, it's even tougher because we always get new highs, new highs, new highs, right, with that uptrend. So of course, it's like kind of also trading against the trend, while trading against the higher time frame trend and trading against a lower time frame trend. While if we go for a long, we're trading with the higher time frame trend and against the lower time frame trend, right? Remember your bell curves. So we're trading, we want to trade with the higher time frame trend, and that may mean that I'm trading against the lower time frame trend, right? And so with that, it makes sense that the lows are much easier to trade. Here we don't get these divergences a lot. Here we just pick, it works picture perfectly, as opposed to here we get first, of course, a divergence. Price goes even higher into a further extreme, and then all of a sudden price changes. And then you would say, well, we get the divergence. Okay, where do we shoot out of those? Where do we break this pivot here? Going on here. Where do we break this pivot? We break it right around here. And so we're breaking that. And so what is being created here is a drop. Is a drop base drop. What we don't want to do with that divergence is we don't want to buy this, right? What we want to do is we want to short this. And so, you know, drop, base, drop, and then we can see this area is being defended multiple times. And as the commercials go lower, even though we get that correction here, price does that correction, look at the non-commercials, they're just going lower and lower. And so with that, the non-commercials will now defend that. They will defend that area. And that now becomes the area, our first area, that we could have technically also traded by looking at our sets of rules, right? And then, of course, if anything, right, we want to short, we don't want to buy. And so this gives you a little bit of an idea, okay, first of all, how do we position ourselves? And secondly, where do we put our demand and supply zones as well? And oftentimes you can see even the ones that are not so quality, they're kind of holding, which is strange. And now you could say, well, now they've been trending down, and of course, price is going down. And so this is only going to change if maybe this trend line breaks. But what is very likely going to happen is that the non-commercials will continue to go lower as price goes lower. And then eventually we will be in some maybe higher quality demand areas. But again, there's so many, right? There's so many. And then down there, maybe the non-commercials will be lower. And then at that point, we can look at trend lines, we can look at consolidation breakouts, and look to short, look to buy then. But what we can also do is, let's say, for example, here we're consolidating, and then eventually the non-commercials go down. And at the same time, we have supply eventually that is created here somewhere. Then we get that retest into supply. Then we trade that new supply on the way down for as long as the non-commercials are going down, right? So there's very rarely a reason, especially since we just changed that trend. There's very rarely a reason to go against that, right? To go against that, because we know that the non-commercials usually, the game that they play is they are trying to get into bigger waves, right? They're trying to get into bigger waves, and they're not day traders. This is also where the term comes from, ride the wave. Trying to get into bigger waves is can be really difficult to do. However, with doing it that way, at least for some forex pairs, we can predict the beginning of major waves. And then also the non-commercials are very unlikely. They're very unlikely to change this here. It could, anything can always happen, right? Because this is after all, this is an uptrend, but it's very unlikely to happen unless they are again at this multi-year extreme, which is these kinds of readings down here is where usually we get rallies from. Sometimes we get them from here, but even that would be lower than here. So that understanding of, hey, those those crazy rallies in the US dollar, they do happen, but they do happen always from these levels of non-commercial extremes. And those non-commercial extremes mean that the non-commercials who are responsible for these downtrends, they ran out of ammo, right? They ran out of ammo. And when they switch, it becomes a domino effect of short squeezes and taking profit, which is also selling, short squeezes, which is people that are selling and then being stopped out with sells on the way up, and also commercials having high accumulation at these areas, and a whole interplay of different things that then creates those crazy moves. But usually they do come from these extremes. So in that case, if we look at the dollar, we're like, hey, we sell the dollar, we buy the euro. In the long run, whatever you do in day trading is then a different story. But in the long run, that should be the game plan. What will change all of this is monthly demand, but we're not going to combine supply and demand and this too much at the moment. What I really need to focus on with you guys is for you to understand one concept, at least conceptually and contextually, and then talk about the next. And then we go really into detail on all of them together and how we combine them. So on the dollar as well, what we could do is US dollar. The non-commercials is also our primary setup tool. Now let's look at Japanese yen as the last one. At JY. So Japanese yen, what we can do is, first of all, we're gonna check what are the highs, and what are the lows, and what are the lows, and how accurate are the lows versus how accurate are the highs, and so on and so forth. And how trending is Japanese yen, right? In this case, even more so than the euro, I think this is a currency that has been downtrending forever, and in a crazy fashion. So the correction moves on the weekly and monthly timeframes, they are very weak. And hence you'll also find, if you're looking to buy, yes, we may get some moves and they may be stronger than others, but overall, what's really interesting are the sell points, right? Those are the moves that are really interesting. And of course, those will be the ones that also are working out better. And it all boils down to what we spent so much time on in the beginning. It all boils down to who the non-commercials are. They are funds, okay? And they speculate. They follow trends, okay? They follow trends until they run out of ammo. And when they run out of ammo, they will be in extremes. And then when they're in extremes, we're like, okay, maybe we should be a little more cautious, or we should look for consolidation breakouts to catch the trend change. But overall, they will go with the trend. So trend above all, right? Trend above all, but not always. When they're at extremes, we have to be slightly more cautious. But Japanese yen is another example where the longer term trend is just so vicious. And if you try to go against that, you will have a tough time making consistent money if you trade at JY to the upside. Right? You will have times where it works, but overall, looking at this, it works less often. Buying works less often. It's kind of like shorting the S&P 500, right? Good luck. It works sometimes, but most of the time we're better off just being buyers for the S&P, and here as well, we're better off being just sellers for at JY. Now, when I look at JY, that's the futures contract for the Japanese yen. You will notice that if you're looking at USD JPY, again, the futures contract is the COT is being removed. However, what you'll notice is that the picture that you see is flip-flopped right here. And so what is happening there is that you have the USD pair as the base currency and JPY as the quote. While if you look at JY, you have the Japanese yen as the base and the US dollar as the quote. Okay. So it's one and the same, but if I'm arguing a sell on JY, it would be a buy on USD JPY. Okay. And if I'm arguing a buy on JY, it would be a sell on USD JPY. I think for JY, it may even make sense to look at the 103XN chart. Let's just see if that makes a difference. 103XN. Yeah, looks different. Okay. Okay, I think this is a proper chart now. So now we can load the fund managers again. And what we're going to do is we can again go a little bit from left to right to see what's going on and what we could have done or what we couldn't have done. And what's interesting is this is an interesting point. Excuse me. Because here a lot of things happen. we have a lot of consolidation, and then we have a breakout of that consolidation. What we also have is major trends that seem to be broken out. And if we were to say, well, if this is our last pivot and we're looking at that breakout of that last pivot here somewhere, then what we want to find is we want to find supply at this area, right? And so supply, I may have supply here. That supply may have never been triggered, right? That supply may have never been triggered. So I may be looking at supply that is never triggered, and then price just goes on and on and on. Where do we create some new lows? We create some new lows here. And here we may have some supply, but again, that is low quality supply. But again, the non-commercials are really viciously defending their areas. When they make a new low, they will defend those new lows like their life depends on it. Here we make a new low. And then again, there may be some supply that's being created, and then price doesn't even get into those areas, right? And then they will defend those areas like their life depends on it. And whenever price gets into these highs and price cannot break those highs, those are reasons for us to sell, right? At least what we're not going to do is we're not going to buy. None of these highs are not broken. These highs are not broken. The very first time where we may break these highs is here, right? And then here we may say, hey, the non-commercials are shifting. The non-commercials are shifting. Again, we look to buy. We may look to buy, and then it's like, ouch, right? Things change. But then very interesting what is happening here as well. First of all, why is the sell working so nice? Well, we just concluded the overall context was down. Why is the buys not working so well again? Well, because the overall context is down. So looking to buy this will always be tougher than looking to sell this. Okay, that's just how it is with the Japanese yen. And now, however, what we get is the non-commercials make a new high, and look what price is doing. Divergence. Do you also know what happened down here? If you don't know what happened down here, and then we talked about this a lot, was a currency intervention by the Bank of Japan. And currency intervention is a big part of your toolbox when it comes to Forex, because whenever a central bank goes in and openly intervenes, and if the central bank goes in and they say, well, you know what, I think we have to buy the Japanese yen because they don't like the depreciation of the Japanese yen. They want to support their own currency. Well, if their own central bank, the Bank of Japan, says that, then you better be buying at that stage. And the interesting part here is that the non-commercials did exactly that, right? The non-commercials did not go into a new low. The non-commercials bought that low, right? They bought it, they held it, and they put a lot of contracts on the table, and eventually price rallied out of this low. Okay, how far did price rally? It rallied to this high. It rallied to this high, and at this high, which was respected, we had supply, and then we had new supply, which then we shorted as the commercials were down there, which then we shorted as price came back up, right? And then maybe we get a little bit of a bounce here, and then profit taking. And the Q is going to be for us now, because what I would argue now is a potential change of trend, longer term, right? A potential change of trend. And because we have, well, these highs are broken. And now it's this high that needs to get broken as well properly for us to change the trend. But it seems like the trend change here is in play, right? So when we're shorting here, we're shorting a potentially with the higher time frame context, but the non-commercials seem like they want to, push this a bit higher potentially, right? They want to create bigger waves. They're not just consolidating a lot of contracts here to get out right away. They're adding and adding and adding, and in adding, they're hoping to catch a big wave. And so that is more likely to happen. The question is, from where is that going to happen, right? Is it going to happen from down here? Very likely that if we get a drop down here again, this will be a major buy opportunity for us, as this is also the area where the central banks intervened. So here we are doing twofold. We were getting a divergence of the non-commercials. Then we saw central bank intervention. Then it's like for us, okay, let's just buy. However, if they come near an extreme and that extreme is holding, then we can look to sell, of course, with the context of that as well, right? It may not be a longer term trade, but it for sure is a good trade, right? And if eventually they're consolidating again and they're moving higher and they're building new demand, in the process, we're going to buy that new demand, right? We're going to buy that new demand because mostly of central bank intervention. But what we will see as well eventually is that the non-commercials should be moving higher, should be breaking these highs. And once they do, it's a clear sign for us to get in to this game. And so that kind of thing happens here on the Japanese yen over and over again. It's a bit more tricky because over times, over long times, the Japanese yen can be sideways trending, right? And during those times when the Japanese yen is sideways trending, of course, what are we going to do? We're going to trade the extremes, right? We're going to trade the extremes because with those moves here, there's not really a lot of consolidation and pullbacks. You only get consolidation and pullbacks with longer lasting clear trends, right? And when you see those changes, and those changes, they have to be quite obvious. When you see those changes, we have to act, right? So here very clearly, it's changing the trend, right? It's changing the trend. I mean, whenever you see that, whether you may be seeing this 1 or 2 weeks early or 1 or 2 weeks later at this stage, when they're clearing that trend and they're breaking these lows, we really need to be shorting, right? And on the other side now, if now we had been downtrending and wherever you want to put that trend line and they're breaking that, then we really need to overall look to be buying. Of course, we're going to be buying in demand, right? We're not just going to buy and blindfold ourselves. So our entry strategy will be buying with demand. However, when we see those shifts is when we have to also shift sides here in terms of whether we want to buy or whether we want to sell. So as you can see on euro and on the US dollar, I think the non-commercials are a little bit easier to read. However, what it's going to take is just time for you to spend with the non-commercials, checking those highs and checking those lows and checking those trend lines and seeing where, when we come from multi-year, that's again important. When we come from multi-year extremes, that's when we pay attention, right? Multi-year high. Why was that a multi-year high? I look back years and years and years, and only 5 years before I find a high. Was that high important? You bet it was important. So we are here again. What am I waiting for? I'm waiting for consolidation breakout. I've got the breakout. Let's go and short this, right? And so it's also where the consolidation breakouts, divergences, where they happen in context of your multi-year extremes, that's going to be important. And so when we go back to the euro example, where I think I've written this down, really, okay. Let me just write it down again to summarize. So what we're really looking is, we're looking at multi-year extremes. Then we're looking at divergences, COT net versus price pivots. Then we're looking at consolidation breakout. And then we're looking at trend breakouts. And what we're going to do is we're going to defend the supply and demand areas with the fund managers and hopefully trade in line with them. And all of that works best with the monthly higher time frame context of trend, right? So if the trend for 10 years has been down, your extremes here that are going to be formed are going to be much more powerful than the lower extremes that take a little bit longer here than to also form. But nonetheless, both ways can be argued. And the last thing that could have been argued on the euro was the change of trend here. And then we break out, and then we buy the demand, the first pullback, and then we look to hold on. And here now we can only buy until we break one of those. Probably not a valid pivot here, but this even we haven't even managed to break yet. What's going to be interesting is to see if the non-commercials in line with price, if price makes a new high, if the non-commercials can also make a new high, if eventually they don't, right? So if eventually if eventually price goes here, but the non-commercials go down, then we know what to do as well in supply, right? Then we're going to short that supply. We're going to short the heck out of that supply if that scenario happens. But that's all from my side for today and on the non-commercials. And that also concludes the COT overall. As you can see, we did a few practical applications on the non-commercials, and we talked about some products where this may be important on. We talked about the retailers as an odds enhancer for silver and palladium, or as a standalone tool on the natural gas. We talked about commercial as the primary fundamental setup tool for our finite markets, wheat, silver, and palladium. And of course, all of that we're always going to do in combination with supply and demand. What we're going to do next time is we're going to start with our valuation model. And we're going to see where that fits into that strategy here, and how we're going to use that for Forex when we look at the US dollar, how we're going to use that for commodities when we look at gold, how we're going to use that when we look at equity indices and stocks, when we look at interest rates. And so that's what we're going to start next time. And so I'm going to end the recording with that. If you have any questions, feel free to hang around to ask some questions. If not, thanks for watching and staying until the end. I'll catch you all in the next few days. Ciao.